the Investor Hub. I've got a brand new web camera, which is very exciting. It means I can do a decent broadcast now just using my desktop, so that's pretty cool. I wanted to have a quick chat about, again, what's happening in the finance markets with particular respect to mortgage borrowers and investors and homeowners. There's been quite a lot of stuff happen since my last broadcast, and I sort of intimated to that we're expecting some changes and the regulators to start getting a bit more heavy hitting in what they're doing. So we've seen interesting conversations with APRA and ASIC and the Reserve Bank in the last week or so. And what they are doing now is they are really turning the screws on lending, and they're putting a lot of pressure on the banks to comply with what they see as fundamental or systemic risk potential in the finance market. So while that's all very lovely, it does have a lot of implications for borrowers. Because it's having implications for lenders, it's having implications for borrowers too. Anyway, sorry, that's a bit dry. So what's happening with respect to regulatory risk is they are putting the screws on interest only lending. So banks are being told that they can't have more than 30% of their new lending being interest only. Given the fact that probably 70% of the lending that I do is for investors and for tax reasons in consultation with their own accountants, they are usually deciding to make those interest only because they've got principal and interest payments on their primary place of residence or their home. I was talking to a bank, BDM, the other day, and he said that fully 50% of their book is interest only at the moment. That's just the sector that they work in. So that's very interesting. But there's going to be restrictions on the type of lending and the extent to which they can do interest only in the future. So that's number one. That's caution number one. Number two is they've certainly keeping the screws on investor lending, and they want growth in the system and individually, bank by bank and institution by institution, to be no more than 10% per annum. And that's not a lot of growth, really, and for some banks, depending on the kind of base that they're growing from. If they wanted to take a set towards investor lending, but they haven't in the past, so they're starting from a base of 10, they can only go to 11. If they're starting from a base of 50, they can go to 55. So, it's an interesting change. And it seems that whilst this has been kind of softly feathered around the edges, they're coming in with a big stick now and hitting the banks with it. So that's number two. Number three, they're basically hard coding servicing requirements in. So they're requiring people to be able to service loans as if they were at like 7.25% on a principal and interest basis, not at 4.5% or 4.3% on an interest-only basis. And a lot of my clients have got loans like that or cheaper. And so for new lending, they're requiring that the benchmark is set very, very high. In fact, it's higher than what the forward markets say this next interest cycle is going to cover. So to me, that kind of sounds like throwing out the baby with the bathwater, but be that as it may, that's just my opinion, and I'm only one guy. So anyway, it is the way it is, and that's the kind of pressure that APRA and the other regulators are putting on banks. So the fourth one, which is I've heard as well in the last week, is that equity release is going to be more difficult, and that's difficult for people who want to invest, because normally if you've got equity in your owner-occupied house, you want to get it out and do some investing, whether that's using it as a deposit for some more property, or whether it's for investing in shares or stocks and bonds, all sorts of other things, investments that are outside the standard scope. You need cash to do that, and a lot of people use the equity in their homes to draw that out. So I've been told by a number of banks in the last week that that's going to get screwed down a fair bit, including one of the ones that I deal with a lot that has in the past has been very free and very happy to release equity. So the goalposts are moving and the times they are changing, my friends. So anyway, that's kind of where they're going with regulating systemic risk. But what that's going to mean in practical terms for a lot of people is that if you're a first home buyer, or you're buying a home to live in and you've only got one house, you're not going to have a problem. It's basically the situation is no different for you, so it won't be any more or less difficult to buy a home because they already had those benchmarks in for servicing and capacity to repay anyway. The only thing that's going to be different about that is that owner-occupied interest-only loans will be a thing of the past. I think you might have. This probably isn't where you read it here first, but I'm going to repeat it. It's not going to be. It's not going to be around very much anymore. Most lenders won't do it because ASIC are saying that if you're buying an owner-occupied home, the objective has to be to pay it off, not to go interest-only and use your cash flow for other things. Isn't that interesting? That the regulators are trying to tell people how to use their money. Interesting. Anyway, so if you've got one or two investment properties, you'll probably be okay. Trying to go to that third and fourth one's going to create some issues at a servicing level, unless you've got a significant income or you've got a lot of equity and your loan to valuation ratios are lower. So you've got more servicing coming in from the rent. So that's going to be another side of things that's going to be a bit more difficult. If you're looking for equity release, we were just talking about that. It'll still be possible, but we'll need more documentation around it. It's going to be harder, and they'll, I did a loan this week for a client. We were releasing $500,000 of equity for them from a property worth $750,000. They owned it outright. So we're releasing equity for them. Now, that's available now. In 6 months' time, bet my bottom dollar it won't be. So if you want to get equity out of a property, I suggest now is probably the time to do that. So that's going to be harder. I've got a few notes here because there's quite a few things I wanted to talk about. So larger investors or investors that want larger portfolios, it's going to be quite challenging. I'm not saying it's going to be difficult, but what I'm saying is that your debt accumulation strategy or your debt accumulation and property accumulation has to be very, very strategic. So the way that you're going about pulling your leverage together is really, really important, and doing things you might have to do things slower, but you'll have to do things in a certain sequence and put one deal to bed before you start the next. It won't be a time for accumulating properties really, really rapidly. There'll have to be a very strict cadence about how you do things, and I think that's going to be the way of the future. So, from my perspective, I actually quite like that because I do like to step people through things at a pace that makes Part A bedded in before we start Part B. Some people sort of tend to prefer to go at a bit of a bull at a gate, but I'd rather make sure things are set up right the first time than having to go back and redo things or perhaps miss out on a purchase opportunity because the structure wasn't right in the first place. So anyway, so what I'm saying about that is your debt accumulation needs to be very strategic, and you really need to be very mindful. And I'll put my hand up for brokers because I'm one, that you need to be in pretty close contact with your broker to be putting that strategy and working on that together to make sure that it really does meet your outcomes and your objectives. So they're the main things: interest only, investor loans, hard coding service requirements, and equity release are the four big things, and they're not going to go away really because of what the regulatory approach to these things is at the moment. It is going to be with us for quite some time until we see a change in economic conditions, really, because the continually strengthening housing markets, particularly in Sydney and Melbourne, are causing some concern at a regulatory level. The populations in Sydney and Melbourne are growing by 9 and 10% a year. That's why property prices are going up. Anyway, but they're still concerned about that because in the absence of any other growth in economic activity, there's not a lot of other action happening in the Australian economy. There's not a lot of other action happening in a lot of world economies at the moment. So they're concerned that the main impetus for growth is growth in asset markets. So that's why this sort of nexus that we're at the moment is here to stay, and I don't think we'll be moving out of this kind of shape from a credit